Mansoor invests in conservative hybrid funds which offer a mix of equity and debt securities, making it an ideal choice for conservative investors. But when Mansoor had started investing in this scheme about 2 years ago, the company had ranked the scheme's risk levels under the moderate category. But now, the scheme's risk levels have been changed from moderate to moderately high. Why does a company change risk categories, and should Mansoor also change his investments whenever this happens? Let's understand. In order to understand all the risks associated with the mutual fund investments, AMCs provide a riskometer. However, many investors like Mansoor do not know about riskometers. As per an Axis Mutual Fund survey dated September 2023, 61% of those surveyed had no clue as to what the riskometer signified. Mutual fund investments are subject to market risks. In such a case, it is essential to understand the riskometer, which measures risk. Whenever there is a change in the proportion of investments made in equities or debt by the asset management company, it directly impacts the riskometer. However, it is not necessary that the risk categories are changed every time. But if there are significant changes made, your risk levels may rise or fall accordingly. And with the riskometer changing, your returns could go up or even fall down. Now let's understand what a riskometer really is. It is compulsory to show a riskometer in all mutual fund scheme documents. This is done so that investors are aware of all the risks associated with the scheme they are investing in. The documents give you a bird's eye view which consists of 6 risk levels beginning from low to very high. Now, what do these levels denote? Let's understand. Mutual funds which fall under the category of low risk invest in those securities which are significantly low on risk. These funds are ideal for those investors who do not want to take any risks on their investments. Generally, these funds also offer low returns and include overnight and arbitrage funds. Funds with low to moderate risk are ideal for those investors who have a medium to long-term investing horizon and are okay with taking on some risks. Ultra-short duration funds fall under this category. Funds with moderate risks are suitable for those investors who are okay taking moderate risks in order to achieve better returns. Most dynamic bond funds fall under this category. The risk level in moderately high risk mutual funds is slightly on the higher end. These work well for those who can bear market volatilities in exchange for higher profits. Funds under the high risk category invest primarily in equities or stocks. So, if you are up for taking greater risks in exchange of higher returns, these funds would be suitable for you. Funds under the very high risk category are considered very risky since they invest in highly volatile stocks or in international mutual funds. These are ideal for those who believe in the maxim of high risk, high returns. As per market regulator SEBI, mutual fund houses are bound to inform their investors of any change in riskometers through their website, newspaper, SMS or email. Every category of mutual funds entails different types of risk. For instance, since these invest in share markets, equity mutual funds are considered highly risky. In the same way, debt mutual funds are low on both risks and returns. Depending on which debt securities the fund manager chooses to invest in, the risk differs from scheme to scheme. Market volatility or ups and downs in the market impact equity-oriented mutual funds. On the other hand, debt securities are impacted by changes in interest rate of schemes they are investing in or due to the financial condition of the bond issuing company. Additionally, inflation also significantly impacts your overall returns. Financial experts note that riskometer should be seen by every investor, especially when there are any changes made to the risk level. Investing in any fund without checking the accompanying risks can adversely impact your returns. Similarly, ignoring the changes in the scheme's risk profile can make you more vulnerable to market ups and downs. Not just that, it will also hit your returns adversely. Shweta Jain, founder of Investography, notes that every investor should check a scheme's riskometer to understand the changes made in the scheme's portfolio. If these changes are not suitable to the risk-taking capacity of the investor, they should always consider switching from that fund. Before making an investment, checking the scheme's riskometer should definitely be on your priority. But then, every slight change in the riskometer should not prompt you to change your investments as well. Riskometers can help you monitor the scheme. But more than the riskometer, investors should always remember their investment objective and time horizon. If you are investing for the long term, changes in the riskometer should not affect you very much. But if you are investing for the short run and there's a change in the company's risk profile, you should definitely consult a financial advisor to understand its impact on your investments.